Welcome to The Deep Dive, the show engineered to cut through the noise and get you straight to the insights that really matter. Today, we're taking a deep dive into something that's, rapidly changing how businesses operate and how we assess their future. We're talking about the brand new IFRS Sustainability Disclosure Standards, specifically IFRS S1 and IFRS S2. Our mission for you, our listener, is to give you a powerful shortcut. By the end of this deep dive, you'll not only grasp how companies are now expected to report on climate risks and opportunities, but you'll also understand what that fundamentally means for assessing their future resilience, how it shapes investment decisions, and even impacts brand value.
And these aren't just, new rules appearing out of nowhere. What's truly fascinating here is the underlying shift. These standards really came about from a growing, undeniable recognition that sustainability-related risks and opportunities aren't just nice-to-haves. They directly and profoundly impact a company's financial position, its performance, and, its cash flows. For a long time, companies were doing voluntary sustainability reporting, which was, okay, but it was incredibly fragmented. Think dozens of different standards, different frameworks. Made it nearly impossible for investors to get consistent, comparable, and, frankly, useful information across companies. That's where the IFRS Foundation, the same people behind traditional accounting standards, stepped in. They saw this global need and created the International Sustainability Standards Board, or ISSB, specifically to develop a global baseline for this kind of critical reporting.
All right, so we've established why these standards exist. The next logical question for, any company or investor is, how do you even begin to structure this whole new world of sustainability reporting? That's where IFRS S1, the kind of fundamental blueprint, comes in. It's called General Requirements for Disclosure of Sustainability-Related Financial Information. Think of it as the master key, really, to unlocking all other sustainability disclosures. It lays out the core principles for how companies should prepare and present all their sustainability-related financial disclosures.
Exactly. And S1 isn't just some vague directive. It really funnels companies' reporting into four crucial buckets, you could say. Each bucket reveals a different facet of how a company is, truly grappling with its environmental and social footprint. The first is governance. This really dives into how an entity's leadership, their board, their management, actually oversees and manages these sustainability risks and opportunities.
Okay, so who's in charge?
Basically, yeah. Then there's strategy. This details the entity's actual plan, their approach for dealing with these risks and opportunities. The third is risk management, which specifies the actual processes they use to identify, assess, and monitor those sustainability-related risks and opportunities. And finally, metrics and targets. This is all about how the entity measures its performance and tracks progress against its sustainability goals, numbers and goals.
So S1 gives them the how-to framework outlining these essential areas. Got it. But what if a company has something really specific to report on, like, say, climate? How does that fit in? Is there a separate standard?
That's where it gets interesting. Companies apply S1, that's the baseline, but they also must refer to other specific ISSB standards when those are available. Right now, IFRS S2 is the only other one they've issued, and that's entirely focused on climate. For anything not related to climate, entities still lean on the IFRS S1 principles. And, they can also look to other resources like the SSB standard for guidance on what topics might be applicable or material for their specific industry.
Okay, that makes sense. S1 is the umbrella, and then specific standards like S2 provide the detail underneath. Now, speaking of S1, I remember reading a really fascinating detail about how companies can handle certain information.
Yes, and this is subtle, but it's important. IFRS S1 actually permits entities to omit information about sustainability-related opportunities.
Opportunities. Okay.
If that information is genuinely commercially sensitive. So, if revealing a new green tech innovation would give away a competitive edge, they might have some leeway there. However, and this is absolutely crucial for you as an investor, this exemption does not apply to any information that's already public knowledge. And critically, it certainly does not apply to sustainability-related risks. Risks always have to be disclosed.
So no hiding the bad news.
Exactly. It forces transparency on the downside, even if the upside can sometimes be kept under wraps for strategic reasons.
But let's look beyond S1 for a second. How are these new standards actually, built? Because this is where it gets really clever, I think. You start seeing these striking parallels with the traditional financial reporting rules many of us already know and trust, and that's a real aha moment because it shows these aren't just some separate, maybe greenwashed new rules. They're built on the same robust foundation investors have relied on for ages.
Precisely. There's significant convergence, which should give users, especially investors, a lot of confidence. For example, both sets of standards, the new sustainability ones and the long-standing financial ones, use the same fundamental qualitative characteristics of useful information. That's relevance and faithful representation, the core bedrock.
Okay, relevance and faithful representation, same as accounting.
Exactly. And they share the same four enhancing characteristics too: comparability, verifiability, timeliness, and understandability.
So for you, the listener, who might be assessing a company, maybe for investment, what does it really mean that sustainability information is now judged as material in the same tough way as financial data? It seems like it gives you a powerful new lens to scrutinize a company's real health.
It absolutely does. It means the definition of materiality itself is identical across both sets of standards. Information is material if, and I'm quoting loosely here, omitting, misstating, or obscuring it could reasonably be expected to influence decisions that primary users make based on those reports.
And the primary users are?
The exact same group for both: current and potential investors, lenders, and other creditors, the people making capital allocation decisions.
Understood. Targeting the same decision makers is huge. What kind of new insights might that unified focus unlock for investors? Things that were maybe hidden before when reporting was separate?
Well, you're getting a much more holistic view, right? Consider this. Sustainability disclosures have to be reported at the same time and for the same reporting period as the related financial statements.
No more lag.
No more lag. No more separate, out-of-sync sustainability report landing months later. And just like with financials, both require comparative information so you can actually see trends over time clearly. Even how they handle errors is the same. Material prior period errors in sustainability info, they have to be corrected retrospectively, just like in IFRS accounting standards. You restate the comparatives.
Wow.
This level of rigor really elevates sustainability data to the same standard, the same level of importance as financial data.
So what this all boils down to for you, the listener, is that these new sustainability standards aren't some completely alien territory. They're not starting from scratch. They're explicitly built on familiar, robust principles that investors and others already rely on for traditional financial information. This gives them a significant level of credibility and, importantly, integration, making them far more actionable for investment and strategic decisions. Okay, so with that robust framework from S1 setting the how, the ISSB then tackled, well, arguably the most pressing sustainability challenge businesses face today, climate change. And that's precisely what IFRS S2 drills down into. It gives us the specific rules of engagement for climate-related risks and opportunities. Its whole purpose is to give primary users the useful information they need to really assess a company's climate exposure.
Right. And when we talk about climate-related risks under S2, it breaks them down into two broad critical categories. First, you have physical risks. These result directly from weather events. Think floods, droughts, extreme heat, or from longer-term climatic shifts like rising temperatures causing sea levels to rise, or even biodiversity loss hitting ecosystems companies depend on.
Things you can, well, physically see or experience.
Exactly. The second category is transition risks. These are the risks that pop up because of the global shift towards a lower carbon economy. Think new, stricter regulations, shifts in consumer preferences towards greener stuff, or maybe disruptive new low-carbon technologies changing the market.
Okay, let's make this really concrete. The source material used an example of an international restaurant business. Let's think about that. For them, a physical risk could be, say, increased flooding due to climate change impacting the supply, the quantity, the quality of key raw materials like grains or produce. That, in turn, leads to price volatility, hits their profit margins. Or you could imagine local restaurants in certain areas facing chronic water shortages, maybe extreme weather events forcing temporary closures, or even just their insurance costs going through the roof.
Absolutely. And then on the transition risk side, for that same restaurant chain, think about this. Climate laws are changing all the time globally. This company operates in over 90 countries. That means potentially huge compliance costs across tons of different jurisdictions.
A regulatory minefield.
Potentially, yeah. And increased regulation can also mean higher operating costs.
Right.
Maybe the cost of energy goes up if they have to switch to cleaner sources, which might be more expensive initially. And maybe most critical for a consumer brand, reputation. If customers feel their climate strategies or targets aren't good enough, their brand value could take a serious hit. Reputational damage impacting market share, maybe even the share price.
It really paints a vivid picture, doesn't it? When you think about that restaurant business, you almost start seeing these risks unfold. It's a lot for companies to handle, but it's not all doom and gloom, is it? There are also some really significant opportunities emerging from this whole shift. if companies are smart about it.
Definitely.
For that restaurant business, an opportunity might be a strategic investment in new, say, energy-efficient technologies for their kitchens or buildings. The expectation there would be a long-term drop in energy use, leading directly to better profit margins and maybe even a boost to their brand image.
Absolutely. And what's crucial here is that for both these risks and opportunities, entities have to disclose not just what they are, but their tangible impact. How do they affect the company's strategy, their decision-making, and importantly, their financial position, performance, cash flows. And this isn't just about right now. They need to look ahead, outline the anticipated effect in the short, medium, and long term.
So it's forward-looking.
Very much so. And to help users judge how adaptable a company is, they also have to provide information about the resilience of their strategy and business model to climate change. This includes details about any climate-related scenario analysis they've done, stress testing their plans against different climate futures. That gives you a real sense of their preparedness.
Okay, now let's talk numbers. The metrics and targets. This is where the rubber meets the road, isn't it? IFRS S2 specifically requires entities to disclose the measurable metrics and targets they use to gauge their performance on climate risks and opportunities. And this crucially includes their greenhouse gas GHG emissions and any climate-related targets they've actually set for themselves.
Right. And when it comes to those GHG emissions, IFRS S2 mandates a breakdown into 3 distinct scopes. This gives a much more comprehensive picture. Scope 1, these are direct GHG emissions from sources the company owns or controls. Think emissions from their own factory chimneys or their company delivery trucks.
Stuff they make themselves.
Pretty much. Scope 2 covers indirect GHG emissions from generating the purchased electricity, steam, heating, or cooling that the entity uses. So the energy they buy and consume.
Okay, their power bill, basically.
In essence, yeah.
Oh.
And finally, Scope 3. This is the big one. Often. It covers all other indirect GHG emissions that happen in the entity's value chain upstream and downstream that aren't included in Scope 2.
Let me throw out some real-world style numbers from the source to make this clear. For year 20x6, this example, company's Scope 1 GHG emissions were about 1.15 million metric tons of CO2 equivalent, up slightly from 1.05 million the year before, 20x5. Scope 2 was about 4.5 million tons in 20x6, actually down a bit from 4.7 million in 20x5. And Scope 3 emissions were around 7.4 million tons in 20x6, also down from about 7.9 million in 20x5.
Okay, thanks for that. Now, why is this breakdown so important for you as a decision maker? Well, think about it. Companies with higher overall GHG emissions are inherently more exposed to climate-related transition risk, right? They'll be hit harder by new laws, tech changes, market shifts, reputation issues, and here's the real kicker. In some industries, Scope 3 emissions, the value chain stuff, can account for almost 90% of total GHG emissions.
90%, wow.
Yeah, think of it like this. Scope 1 and 2 are kind of like the emissions from your own house, your car, your heating, your electricity. Scope 3 is everything else in your life that causes emissions, but isn't directly under your roof, the food you buy, the flights you take, the stuff you consume. For a company, Scope 3 is this vast, often unseen iceberg beneath the surface. It's a critical hidden risk if it's not disclosed.
So ignoring Scope 3 gives a totally misleading picture.
Totally. So mandating Scope 3 disclosure gives a far more complete view of a company's total carbon footprint. And crucially, it lets investors actually compare the impact of companies with different business models. For instance, a company that outsources all its manufacturing versus one that does it all in-house. Scope 3 helps level that playing field for comparison.
And to make sure everyone's counting the same way, IFRS S2 says GHG emissions generally have to be measured using the Greenhouse Gas Protocol standard from 2004, unless some local law requires a different method. That standardization is key for comparability, right? Reduces bias, helps ensure faithful representation, apples to apples.
Exactly. Now, moving from emissions measurement to targets, let's look at another example from the source material this time, an international hotel business. This company aims to cut water consumption per occupied room by 20% from a 20x8 baseline by the end of 20x9. By the end of 20x6, they'd managed an 8.4% reduction.
Sounds like they're a bit behind schedule on that one.
Yeah, clearly behind pace. They also plan to reduce net carbon dioxide emissions by 30% from that same 20x baseline by 20x9. Now, this target is interesting because it involves a 10% gross reduction, actual cuts in their own emissions, and the use of carbon credits to offset the rest.
Offsets.
Offsets, yeah. So by 20x6, they'd achieved a 24% net reduction, looking good there, but only a 2% gross reduction.
So mostly relying on credits so far.
Seems like it.
They're way behind on the actual direct emission cuts target. But interestingly, they've put in a share-based payment scheme for their executives that only pays out if this overall goal is achieved.
Skin in the game. That certainly focuses the mind.
It shows they're linking compensation to these targets, which is significant.
Okay, but that raises a really important question for me. Why does IFRS S2 make companies disclose both the net and the gross GHG emission targets if they set a net target? Why not just report the net number they're aiming for?
That's a crucial distinction and a really insightful question. The reason is, well, a reduction in net GHG emissions can be achieved without fundamentally changing how the company actually operates day to day. Like we thought, a company could hit its net target purely by buying carbon credits. And a carbon credit is, by definition, an emissions unit, representing an emission reduction or removal done elsewhere.
So it's not their reduction?
Not directly from their operations, no. So IFRS S2 requires entities to disclose their planned use of these carbon credits to meet any net target, precisely because the quality and effectiveness of credits can vary a lot. Plus, regulations around them can change, their prices can fluctuate wildly. All of that impacts whether a company can actually affordably meet its target using credits.
Makes sense. You need transparency on the plan.
Exactly. Disclosing both the gross target, what they'll cut themselves, and the net target, the final number after offsets, and explaining how they plan to bridge that gap with credits. It just provides a far more transparent and complete picture for you, the user. It lets you assess the real operational changes versus how much they're relying on offsets, which carry different risks.
Okay, incredible. So you've just gained a massive shortcut to understanding these critical new IFRS Sustainability Disclosure Standards, S1 and S2. You now have a much better grasp of why they exist, what they cover, how they cleverly connect to traditional financial reporting, and the specific details around climate risk opportunity, those GHG emission scopes, and the crucial targets companies are setting and reporting on. You're definitely better equipped now to understand the story behind the numbers.
Yeah, and if we just take a step back, connect this to the bigger picture, these standards are fundamentally changing how investors, lenders, other creditors, how everyone assesses a company's true value and its future resilience. It's a really significant systemic shift. We're moving beyond just the traditional P&L and balance sheet to incorporate the profound and, frankly, growing impact of sustainability factors on whether a company will even be viable long term.
So as you go about your day, here's something to think about, a final thought to mull over. How might these newly mandated sustainability disclosures, this push for transparency, not only influence individual investment decisions, but maybe subtly, or perhaps not so subtly, drive broader, more meaningful changes in corporate behavior? Could it spark more innovation across entire industries? Could it actually be pushing us all towards a more transparent and maybe, just maybe, a more genuinely sustainable global economy? Something to consider until our next deep dive.